Yo, what's going on, you guys? You know what it is. We're back, man. And today we are going to be going over risk management 101. And I know why you probably clicked this video, because you want to learn risk management. Maybe you struggle with it, maybe you don't, maybe you just want a refresher. But today I'm going to go ahead and dive into some, great theories I like to believe in when it comes to risk management. Some R to R plus win rate examples for you guys to see what that looks like, and just how I personally like to break down my risk at the end of the day. And giving you guys an opportunity to see how you should be doing it. And again, this is risk management 101, so these are the very basic principles of what you should be learning. Make sure you guys check out our new Discord. The free Discord is actually completely shut down right now, if you don't know, and we only have the VIP Discord at the moment. So use code NY26 and that'll get you a free month into the VIP Discord. Again, NY26 will get you a free month into the VIP Discord. We are live trading in there, sending signals, live news feed, fundamental reports, trade breakdowns, market outlooks, mindsets, all of it. It's where we're in there. It's where our community is. It's our main chat in there. It's everything. So make sure you guys check that out. Again, free month, NY26. And then also make sure you guys follow me on IG at ThatTraderX. But neither here nor there, let's go ahead and get into the video. So you guys, as we can see, today we're going over risk management. And this was actually a slideshow I made for the MTM VIP members. They did get to see it before you guys, as well as it was live, so they were able to get feedback from me, ask questions, etc. So VIP gets to see it first always, and they're getting a little more sauce on top of this, So NY26, make sure you're there. So the importance of risk management. Risk management is the system that protects your account so you can stay in the game long enough for your edge to play out. It tells you exactly how much you're allowed to lose per trade, per day, and per week. So one bad decision, one news spike, or one emotional moment can't wipe out weeks or even months of progress. The goal isn't to avoid losses. Losses are part of trading. The goal is to control the size of the loss. Keep your drawdowns small and make sure your winners have the room to outperform your losers over time. When risk is controlled, you trade calmer, execute cleaner, and you give yourself a real chance at consistent profitability. So you guys, risk management isn't just some myth that we make up as traders. It's really a bread and butter, and it's a core of all of it. You have to have great risk management, and you have to have a purpose behind it also. This is titled the purpose of risk management, but you also have to have a purpose of why you're setting up your risk management, and it's everything. It allows you, like it says, to trade calmer, execute cleaner, and give yourself a real chance at consistent profitability. At the end of the day, this is a long-term game. It's not overnight. So now let's go ahead and get into risk to reward ratio plus win rate. Risk to reward ratio and win rate work together to determine whether you're profitable long-term. Risk to reward, also known as your R to R, is how much you're trying to make compared to what you're willing to lose. Example, if you're risking $100 to make $200, that is a 1 to 2 risk to reward ratio. Your win rate is how often your trades win. The key is you don't need a crazy win rate if your R to R is solid, and you don't need a huge R to R if you have a crazy high win rate. This slide will show you how to pair the two so your strategy has a positive expectancy. What win rate you actually need at different R to R levels, and why traders blow accounts when they chase wins instead of managing their losses. Just to sum it up, risk to reward ratio is how much you're looking to risk to gain. So if you have a 1 to 7 risk to reward ratio, risking $1,000, you're looking to make $7,000. And obviously win rate is pretty simple. If you have a 50% win rate, it means you win 50% of the time, you lose 50% of the time. But if you have that positive R to R ratio, the whole game can be changed. One win, which is a 1 to 7 R, will make up, say, $1,000 you're risking to make $7,000, you make $7,000. You can lose $1,000 7 times before you actually blow your account. So you can have a 30% win rate with a 1 to 7 risk to reward ratio, and you can still be almost profitable. Almost. You'll be at like break even. If you have a 40% win rate, or a 35%, or even a 33% win rate with an average expectancy of a 1 to 7 risk to reward ratio, you're very likely to be profitable. So now let's go ahead and jump into R to R plus win rate projections. What you're looking at here is a 90 trade sample size, where we risk a fixed $1,000 per trade using a 1 to 3 risk to reward ratio, meaning every loss is minus $100 and every win is plus $300. So currently we're trading a 1 to 3 risk to reward ratio. The whole point of this slideshow is to show why risk to reward is so powerful. When your winners are consistently bigger than your losers, you don't need to be right all of the time to make money. Even a normal win rate can still produce solid results over time because your wins do more damage, in a good way, than your losses do. So, and when I say a normal win rate, you guys, everybody's win rate's different. There's really no normal win rate. We can say normal is a 50% win rate. You win half the time, you lose half the time. Maybe we'll call that normal. So as we go ahead and dive down into the graph here, the percentage will be our percent win rate. We do have a fixed 1 to 3 risk to reward ratio with $100 risking every time to make $300 over a 90 trade sample size. And this doesn't play into your trade management. As some of you guys know that are a little more advanced, when you have different trade management, you're not always hitting that 1 to 3 if you're scaling out or you get stopped in profit. There's a couple other variables, but very basic and very simple math for the people who don't completely understand this yet or aren't currently applying this to their trading. So first, if you have a 10% win rate with a 1 to 3 risk to reward ratio, over 90 trades, you are actually gonna end up negative $5,400. So you aren't actually able to become profitable with that. You're still gonna be a loser. Not you personally, but your positions. Now, if you have a 30% win rate with a 1 to 3 fixed risk to reward ratio over 90 trade sample size, you will actually come out on top, risking $100 each time after 90 plays with 30%, with a 30% win rate, you'll make $1,800. So, that's actually decent. Again, you guys, you're only winning every 3 out of 10 trades. If you take 90 trades, what's winning 30% of that? You win 30 and you lose 60 trades and you still make $1,800. You still are profitable because of your risk to reward ratio. Now, even a normal, quote unquote, normal win rate, because everybody, everyone's different. Over 90 trades with a 1 to 3 risk to reward ratio, you'll end up at a $9,000 positive P&L curve after 90 days. That's great. For winning half your trades, you take 90 trades, you only won 45 of them. You only won 45 of them. You lost the other half, and you still made $9,000, all by risking $100 per trade. That's all just based off of $100 risk per trade, you guys. It's super little. Think that's actually crazy. Now, if we even move up even higher to a 70% win rate, risking only $100, you guys, with a 1 to 3 risk to reward ratio here, with that 70% win rate after 90 trades, so let's just say 3 months, you're actually gonna end up in the positive at $16,200. If that's not great, I don't know what is. This is the best though. Sometimes you'll find yourselves in areas where you have a 90% win rate. And as a trader, trading these markets, sometimes it actually fluctuates. Sometimes you might have a couple weeks where you have a 30% win rate. You're just getting smoked, but you're still profitable. And other times you have a 90% win rate. You're actually absolutely cooking the market and you're still profitable. So as long as you stick to the system at the end of the day and don't overdo it, make sure you stick to your plan, make sure you stick to your RR, make sure you track your win rate and see actually what your results are. It can turn out great for you. It can turn out great for you. So here's a little diagram for you guys just to see what actually paying attention to your risk to reward plus your win rate looks like over a 90 trade sample size. And again, some pretty fixed numbers. Everything is not nearly as fixed when it comes to the live markets, but great example. Now, time for my favorite thing, which is gonna actually be the revolver theory. This is how I personally like to teach risk management. This is how I personally view my own risk management. I don't know if anyone else uses this theory or not. I kind of just coined it myself. If someone else did, hey, sorry, but the revolver theory is mine now. What is the revolver theory? Revolver theory is about how many chances you give yourself to hit your target. Every trade is a trigger pull, and your risk per trade determines whether you have 2 bullets, 5 bullets, 15 bullets, or 20 bullets before you're forced out of the game. If you risk too much, you don't get enough attempts for your edge to play out. If you manage risk correctly, you give yourself plenty of shots to catch the setups you're waiting for and let the probabilities work in your favor. So as we saw in the previous diagram, you guys, you actually have to let the probabilities play out in your favor. You're not gonna win every trade. A 50% win rate over 90 trades, you win 45 trades. So, you have to expect 45 losses. Maybe in that instance, you should give yourself 45 bullets because within those 45 bullets, if you have a 50% win rate, you're gonna win. You're gonna win at the end of the day, and that P&L curve will shoot you up. Here are 4 examples based on a $20,000 personal account balance, and after this I'll actually go into a funded account balance and another example of how you can break that down. But here's 4 examples of a $20,000 personal account balance. With 20 bullets, risking $1,000 per trade and 20 straight losses blows the account. 15 bullets, risking $1,333 per trade, 15 straight losses blows the account. 5 bullets, $4,000 per trade, 5 straight losses will blow your account. 2 bullets, risking $10,000 per trade, 2 straight losses blows your account. Again, if you got something like a 90% win rate, you can give yourself 5 bullets if you're gonna survive it. You're gonna hit your target. But that's the whole point of the revolver theory, is how many shots do you need before you're out of bullets? How many trades do you feel like you need? If you feel like you could crush it, go ahead and try the 2 bullet theory. Give yourself 2 opportunities. just know, when you're breaking down your risk at the end of the day, if you give yourself 2 bullets, you have 2 chances. You give yourself 20 bullets, you have 20 chances. You give yourself 5 bullets, you got 5 chances, so on and so forth. Now, if we go ahead here into our 4 examples based on a $150,000 funded account balance, which I went ahead and put the max drawdown at $6,000 because, as you guys know, most funded accounts have a max drawdown limit. So it's not the whole $150,000 you're actually getting. Your max drawdown here would be $6,000. So let's get into this. 20 bullets. You're risking $300 per trade. You take about 20 straight losses before you hit your $6,000 drawdown limit. Again, 15 bullets, $400 per trade. You can take about 15 straight losses before you hit your $6,000 drawdown limit. 5 bullets, 5 straight losses before you hit your $6,000 drawdown. 2 bullets, $3,000 per trade, 2 straight losses, you're out the game. So the whole goal of risk management, you guys, is to be in the game as long as possible, especially when you're learning. You definitely don't want to just blow up early on and you have no more chances. Give yourself enough chances to learn how to hit the target. You need to learn how to pull the trigger. You need to learn how to aim. You need to learn how to up the, So it's very important you guys pay attention to how many bullets you're giving yourself. Me personally, maybe sometimes I give myself 30 bullets, just because why do you want to be backed against the wall with 2 bullets feel like you're fighting 10 people? No. Let's feel like, we're chilling. We got 30 opportunities. We have more than enough chances to hit our target. And we know we can hit our target based off of our win rate plus our projections. We know how many bullets we need. You should be able to figure out how many bullets you need based on that. Now let's go ahead and move into your account risk versus your daily risk. So part 1 being account risk. Your account risk, it as the total number of bullets in your revolver. Maybe you have 20 bullets for your entire account before it's fully depleted. That's your account risk. Now you have your daily risk. Your daily risk is how many of those bullets you're willing to use each and every day. In other words, each day you can take a few bullets from the main stash, and once you've used them, you stop for the day so you don't run out of your overall ammo, blow your account too quickly. So the whole goal, you guys, again, you just can't blow the account, you know what I mean? Just don't blow your account. That's like the golden rule, number 1 rule. And it's okay if you do, it happens to everyone, but let's at least take the precautions so we don't get there. So, you have your overall account risk. And with that account risk, you give yourself, let's say 50 bullets. Every day you want to give yourself 5 opportunities. So, you got 50 bullets every day, you'll give yourself 5 opportunities. Sometimes you'll hit on bullet number 1, sometimes you'll hit on bullet number 3. But if you use all 5 bullets, you usually know, hey, my clip's empty for the day. I got to go back, wait, reload, I'll come back tomorrow. So now what can be your next steps? Choose your bullet count. Set your account max loss and your daily max loss. How many chances you're willing to take. Lock in your per trade risk. Pick a fixed dollar or percent to risk and keep it the same every trade until you prove consistency. So you guys know at MTM, we teach a little bit of a different scaling and model to our positions. But if you don't already know how to manage your risk and scale into entries, and if you're just not there yet, that's okay. There was a time I was taking fixed dollar and fixed percent positions strictly, and it still is kind of a fixed number at the end of the day. I'm just breaking it down a couple different ways, even for myself and all the traders trading with us at MTM. Start out with that fixed amount. Hey, you want 2 bullets a day, you want 20 bullets in general on a $20,000 account. That's about what? $500 per bullet. You can even sometimes cut your bullets in half. Maybe you take 3 bullets out the stash, but you really want 6 shots that day, so you even cut your bullets in half again, and you give yourself even more opportunities by cutting that risk in half again. So it's just about how many opportunities you have. Think about how many shots you need to hit the target. Now follow a shutdown rule. Hit your daily limit, you're done. No more trades. And then track your next 90 trades. Journal outcomes in R and review weekly to tighten your execution. So journal the R, what's your R to R ratio? Pay attention to your win rate. If you got a 1 to 0.5 risk to reward ratio with a 40% win rate, you can't be profitable like that. Mathematically, you're not going to be profitable. There's no way to make that make sense. So, track your next 90 trades and see what's making sense for you. That being said, thank you for joining today's session. If you take one thing from this webinar, let it be this. Risk management is the foundation that allows your strategy to perform over time. Apply the rules we covered, stay consistent with your sizing and limits, and commit to tracking your next 90 trades so you can build real, measurable progress. And of course, feel free to reach out with questions in the VIP main chat portion of the Discord. So again, plug is NY26. Throw that NY26 code in there, you guys, and that's exactly how you'll get a free month in the Discord. Again, we ran this webinar already for free for our people, and we actually answered questions and helped them build out bullet strategies themselves using the revolver theory. So if you're not in there, NY26, get in there. We're not that sale's only gonna last about 3 more days for the free month. And that's just one thing you're getting. Just one thing is these valuable webinars. So I hope you guys took something away from today. Make sure to like, make sure to comment, make sure to subscribe, as well as follow the YouTube, and we'll see you guys next time. Peace. That's that really gay.